Gold isn't just making new highs, it's cornering the market into admitting something it's been trying to explain away for years. The biggest buyers in the room aren't done, and the headline story is mostly camouflage. You're going to hear that this latest surge is just another fear spike, another knee-jerk safe haven reaction, another emotional stampede. But the move is cleaner than that, and the pressure is deeper than that, because the real signal isn't the headline. It's the way the market keeps finding a bid, even when it should be tired. And later in this video, I'm going to give you the 1-week checklist. What level matters, what confirms the next leg, what breaks the setup, and why the calendar is quietly doing more work than any pundit on TV. Start with what just happened. On January 19th, 2026, gold pushed into fresh record territory around the high 4,600s per ounce, while stocks wobbled and silver ripped to its own extremes. The easy explanation is the one everyone loves. Trade war anxiety, tariff threats, geopolitical noise, risk off. Pick your label, slap it on the chart, and call it a day. In fact, the trigger was loud enough to make that story feel complete. A new tariff threat aimed at multiple European countries, a deadline attached to it, and a political conflict that instantly feeds the safe haven reflex. That's real. That's not nothing. But it's also the kind of story that arrives when a market is already primed, already tight, already leaning, already vulnerable to a small shove turning into a big repricing. That's where the real pressure starts. Because if this was only about one headline, you'd see a pop and fade. You'd see a spike and a sag, you'd see price surge, then liquidity return, then sellers show up to take profits, then the market cools off. That's how one-off fear trades behave. But gold's behavior lately has been different. It's been stair-stepping, it's been absorbing dips, it's been acting like there's an underlying buyer who treats pullbacks as inventory restocks, not as reasons to panic. And that buyer is exactly who most investors keep underweighting in their mental model, central banks and official sector demand. Plus, the institutions that follow, once they sense that official bid is not a rumor, it's a regime. Now, let's lock in the price context so we're not waving our hands. Into mid-January 2026, gold was already elevated, and then it pushed to a new record near $4,789 on the day the tariff threat hit. That means we're not talking about a sleepy market that woke up for a quick adrenaline shot. We're talking about a market that has been repricing the cost of trust for a while and then got a calendar catalyst that accelerated it. And that's the first clue that central banks aren't done, because central banks don't buy gold like a retail trader buys a dip. They buy it like an engineer adds redundancy. They don't wait for the bridge to crack. They reinforce the structure while the public is still arguing about whether the bridge is even real. But that's not the part that matters. The part that matters is the hidden detail, because the hidden detail reframes everything. Central bank demand is big, but what's underappreciated is how it shows up in the market. It's not always a clean, real-time neon sign that says, official buyers bought today. A lot of it is reported with lags. Some of it moves through channels that don't light up your screen in the moment, and some of it effectively removes available float in a way that the paper market doesn't fully price until it's forced to. In other words, the market can look liquid on paper, while the pool of willing physical sellers is quietly shrinking. That's where the math changes. So when people say, yeah, central banks bought a lot already, so surely they pause, they're thinking like a trader. Central banks are thinking like balance sheet managers with long horizons and political constraints. Their objective is not to beat the S&P this quarter. Their objective is to reduce single point of failure risk in reserves, to hold an asset that is not someone else's liability, and to hedge a world where payment rails, sanctions, asset freezes, and currency concentration risks are not theoretical. That's the conflict. The public wants a short-term story. Official buyers are executing a long-term architecture change, and we have evidence this isn't just vibes. In 2024, net central bank gold buying reached roughly 1,045 tons, with a heavy Q4 that pushed the annual total over that threshold. That's not a casual, maybe we'll add a little. That's a strategic allocation wave. And then in 2025, even when the pace slowed from the most extreme prior year sprint, the buying remained elevated. In the World Gold Council's Q3 2025 demand data, central banks were still net buyers to the tune of about 220 tons in that quarter, up meaningfully from the prior quarter, and year-to-date net buying was still in the hundreds of tons by Q3. That's the point. Slower doesn't mean stopped. Slower just means the market has to work a little harder to notice it. Here's why that matters for price discovery. Gold isn't like a tiny altcoin where one whale can flip the market instantly. It's deep, it's global, it has multiple venues, multiple forms, multiple settlement habits. The paper market, futures, forwards, options, can look enormous, and it is enormous, but paper doesn't create physical metal. Paper creates claims, hedges, and synthetic exposure. Physical is the underlying constraint. So if the official sector is steadily accumulating physical gold and holding it as a reserve asset, That metal is not in the float that can be easily mobilized when price moves. It's effectively removed from the pool of marginal supply. And when marginal supply gets tighter, the market's tolerance for shocks gets lower. The next detail is what flips the whole setup. Let's talk mechanics without turning this into a textbook. The gold market has a cost of carry structure. In plain language, if you hold physical gold, you have storage costs and financing costs. Because of that, gold is often expected to trade with a gentle upward slope in the forward curve, what traders call contango, where future delivery is priced a bit higher than spot, reflecting those carrying costs. When that relationship strains, when near-term physical demand is strong, or financing tightens, or the market craves immediate metal, you can see the curve flatten or even invert in pockets. You can see stress in lease rates, in swap activity, in the way spot, and forwards dance around each other. You don't need to memorize the jargon. You just need the so what. If the market is paying up for immediacy, that's a physical signal, not a headline signal. And when physical signals persist, it means the underlying demand is not just emotional, it's structural. Now stack proof on top of proof, because one argument isn't enough. Proof point one is the tape itself. Record highs into mid-January with a clean acceleration on a calendar-driven headline. That suggests a primed market. Proof point two is the official sector behavior. 145 tons net bought in 2024 is a statement of intent. Proof point three is persistence. Central bank buying remained elevated in 2025's data, including that roughly 220-ton net purchase quarter. Proof point four is the institutional echo. In Q3 2025, ETFs saw massive inflows on the order of a couple hundred tons. And that matters because ETFs are how a huge cohort of capital expresses exposure quickly. When ETFs and official sector demand line up, you don't just get a gentle drift higher. You get air pockets on the way up because the market realizes it's underowned. And proof point five is the reserve composition drift in the background. IMF data on currency composition of reserves has been showing a continuing trend of diversification. Small changes quarter to quarter, but persistent. Even when the dollar remains dominant, the direction of travel matters, because gold is the neutral reserve asset that doesn't depend on any single issuer's political tolerance. But that's not the only layer. Add supply chain reality. Gold supply does not respond instantly. Mines take years to develop. Grades decline. Permitting takes time. Refining capacity has bottlenecks. Recycling rises when price rises, yes, but it's not infinite, and it's sensitive to consumer behavior and local liquidity. That means when demand spikes, especially demand that is price insensitive because it's strategic, supply can just turn on a faucet. The market has to ration demand through price. That's literally what price is for. And when you combine strategic buyers with slow supply response, the market becomes reflexive. Higher prices validate the thesis for institutions, which brings in more capital, which tightens the market further, which pushes price higher. That's how trends sustain. And that's where the other side, banks, market makers, hedgers, gets forced to do uncomfortable things. Because here's the part most people don't think about. A lot of the drama in gold isn't about someone making a bold prediction. It's about risk management and positioning. Futures markets are full of hedgers and speculators. Options markets are full of dealers who have to hedge their exposure dynamically. When price starts to move quickly through key strikes or key levels, dealers may need to buy as price rises to stay hedged, especially if the market structure shifts into a zone where gamma dynamics amplify moves. You don't need the equations. You need the implication the market can create forced buying on the way up and forced selling on the way down, even if nobody changed their mind fundamentally. That's why gold can whip around violently even when the thesis is correct. The tape isn't just belief, it's mechanics. So let's steelman the skeptical case, because you should never build a thesis that collapses the moment someone raises a serious objection. The skeptics say, gold is already extremely high. Central banks bought a ton. At some point, they pause. Also, higher yields can pressure gold. Also, this looks like a mania. Those are not stupid points. Those are exactly the points that get you hurt if you ignore them. But here's the rebuttal, and it's mechanical, not emotional. Strategic reserve diversification doesn't require a perfect entry, and official buyers operate on accumulation programs, not on your daily chart. They can slow, they can pause, they can shift among buyers, but the structural incentives haven't evaporated. The geopolitical and payment rail landscape is still a feature, not a bug. The desire for assets outside another sovereign's control is still rational, and the market has already shown you that demand doesn't collapse just because the sticker price is higher. The next detail is what flips the whole setup. It's not just who is buying, it's who is forced to respond. Think about what happens when a big, persistent buyer keeps absorbing supply. Volatility rises, shorts get more cautious. Carry traders get more sensitive to funding and borrow conditions. Physical dealers tighten spreads or widen them depending on inventory. Jewelry demand might soften on volume at high prices, sure, but that doesn't automatically translate into more supply, because it can also translate into less recycling, less willingness to part with heirloom gold, and more hoarding behavior in certain regions. Meanwhile, on the institutional side, underallocated portfolios feel pain as gold makes new highs. Then you get the performance chasing phase. Then you get the we need to add a little phase. Then you get the we should have added earlier phase. That's the emotional arc, but the mechanism is straightforward. When underowned assets trend, demand shifts from optional to mandatory. That's what creates the step-like price action. Now bring the calendar back in, because the calendar is the catalyst. The tariff threat wasn't just a headline. It came with dates, February 1st as an initial start, with potential escalation later. Deadlines matter because markets price risk into the future, and when a deadline is close, the distribution of outcomes gets fatter in traders' heads. That increases hedging demand. That increases option demand. That increases the need for liquidity. And in January, liquidity can be thinner than people think, because positioning is being rebuilt after year-end, risk budgets reset. And the first real stress test of the year often reveals who is underhedged. Also, month-end isn't just a calendar note. Month-end is when big funds rebalance, when systematic strategies adjust exposure based on volatility and trend signals, and when paper flows can collide with physical tightness. So yes, the headline pushed the market. But the calendar created the runway, and if this one level breaks, the math changes. So what are you supposed to watch now, in the next week or two, if your attention is fragile and you refuse to be emotionally played? You watch the tells, not the talk. First, you watch whether dips are being absorbed quickly or whether they linger. Quick absorption, meaning the market sells off and then gets snapped back, suggests a strong underlying bid. Second, you watch the zone around the most recent breakout area. Since gold printed around the high 4,600s at the peak, a reasonable support zone is the mid 4,500s down into the low 4,400s, because that's where you'd expect buyers to defend if this move is a genuine repricing rather than a one-day spike. Third, you watch for a retest behavior. Does price come back, kiss a prior level, and then hold? Or does it slice through like there's no real sponsorship underneath? That distinction is everything. Fourth, you watch the risk on risk-off narrative trap. If stocks bounce, does gold immediately dump and stay dumped? If gold holds up, even when the fear headline fades, that tells you the demand is not only reactive, it's structural. And fifth, you watch the shape of volatility itself. Are we getting large intraday ranges that resolve higher, or large ranges that resolve lower? That tells you whether forced flows are buying or selling into volatility. Now here's the two-scenario lens you need, because it's the easiest way to stay sane. Scenario one is the controlled pullback and retest. In this scenario, gold cools off from the record high, maybe retraces into that mid $4,500 to low $4,400 zone, shakes out weak hands, gets the media to declare the move is over, and then finds a bid again. Confirmation here is simple. Higher lows, quick dip buying, and a failure to break down below the prior breakout region for more than a brief flush. If this scenario plays out, the market is building a base at higher levels, which is exactly what long-term buyers want. They don't need fireworks every day. They need the floor to rise. Scenario two is the continuation squeeze. This is the one that feels exciting and terrifying at the same time. In this scenario, the market doesn't give you a clean pullback. It keeps pushing higher in spurts, often in thin liquidity, often around catalysts and deadlines, sometimes with gap risk that punishes anyone who insists on waiting for the perfect entry. Confirmation here is the opposite of comfort. Shallow pullbacks, fast rebounds, and the sense that sellers can't get traction. This can be amplified by options dynamics, by short covering, and by the simple fact that when a market makes new highs, it forces a conversation in every risk committee on the planet. And those conversations often end with one sentence: we should add some. That's where the real pressure starts. But you also need invalidation levels, not because you're negative, but because you're serious. What would weaken this thesis in the near term? A clean, sustained breakdown below the prior breakout region. Think a move that decisively loses the low 4,400s and doesn't snap back would be a yellow flag. Not because gold is over, but because it would imply that the move was more headline-driven than structural in the short run. A meaningful shift in macro conditions that strengthens the currency environment and reduces hedging demand could also pressure gold temporarily, especially if it triggers ETF outflows or dampens institutional appetite. And a visible sustained cooling in official sector buying over multiple quarters would matter, though remember, official data lags and can be noisy. The key is persistence. One data point doesn't change a regime, a trend does. But that's not the part that matters. The part that matters is how you, the viewer, get manipulated in the middle of all this, because markets don't just move money, they move emotions. And volatility is the tool. And when gold rips, the media will tempt you with certainty. They'll give you a single cause narrative. They'll make it feel inevitable. That's how people buy tops. When gold dips, the same media will flip the narrative instantly. The trade is over. The bubble popped. Investors have moved on. That's how people sell bottoms. Your defense is a framework. Your defense is naming the scenarios in advance. Your defense is remembering that trend signals and noise are not the same thing. A trend signal is structural, persistent demand, rising floors, repeated dip absorption. Noise is the day-to-day slap fight between headlines and positioning. So here's a simple psychology shield you can actually use. First, decide what time horizon you're operating on. If you're watching this because you care about macro regime shifts and reserves, you should not let a one-day candle rewrite your identity. Second, size your exposure so you don't need price to behave politely. If your position is so big that a 2% or 3% intraday swing makes you sweaty, you're not investing. You're gambling on emotional stability. Third, pre-commit a rule for what wrong looks like. Not it went down, but it violated the structure. That could be a sustained break below a defined zone or a shift from higher lows to lower lows or a change in how dips behave. Fourth, avoid the trap of overreacting to the loudest headline. Headline-driven moves happen on top of structural forces. They don't replace them. And fifth, remember this. The market's favorite trick is to make you abandon the right thesis at the wrong time by speeding up and slowing down at exactly the wrong moments. That's where the other side wins. Not by being smarter, but by being calmer. Now, let's tie this back to the title in the most direct way possible. Why aren't central banks done buying gold? Because the incentives that drove the buying are still intact, and the market is still behaving like there's a non-negotiable bid underneath. Central banks are not buying gold because they think it's trendy. They are buying it because it asks neutral collateral in a world where neutrality is getting scarce. They're buying it because reserves are about survivability, not bragging rights. They're buying it because concentration risk in reserve assets is a real thing, and the political and financial architecture of the last few decades has shown stress fractures. They're buying it because if you're a sovereign, you can afford to find out the hard way that your reserves are only liquid in friendly weather. And it shows, because price is doing something that pure retail emotion can sustain on its own. It asks trending with structure, not just spiking with fear. And now the practical part. If you want to be ready for the next 1 to 2 weeks, here's the checklist in narrative form. Watch whether gold can hold above the mid $4,500 on pullbacks. Watch whether the low 4,400s acts like a line in the sand or like wet paper. Watch whether any dip is met with immediate demand or whether sellers finally get follow-through. Watch how the market behaves around the calendar catalysts, policy headlines, tariff deadlines, month-end positioning, and any surprise, geopolitical escalation. Watch for volatility tricks. If gold sells off sharply and then recovers just as quickly, that's often a sign of forced liquidation being absorbed by stronger hands. And watch for the everyone agrees moment. When the narrative becomes too clean, the market often punishes complacency with a violent shakeout. That's where the real pressure starts. If you're in the metals crowd and you've lived through enough cycles, you already know the rhythm. The market gives you an emotional test before it gives you clarity. The objective isn't to predict every tick. The objective is to understand the mechanism well enough that you don't get psychologically hijacked by the noise. And that's why I am saying central banks are in done, not as a dramatic claim, but as a structural observation backed by the behavior we've seen, multi-year elevated official sector demand. Continued net buying, even at high prices, reserve diversification trends in the background, and a market that acts like dips are opportunities rather than endings. One last thing before we land this. If you want to build real edge in this space, you don't do it by collecting hot takes. You do it by collecting frameworks, then testing them against the tape. If you're the kind of person who wants the mechanics, the stress gauges, what invalidates this discipline, and not just the dopamine, then you're already in the right tribe. Stick with that identity. It matters more than any single candle.